5%. And we had a market risk premium of 6%. So that's all we had to do is substitute in beta to get the required return. And let's see, just to kind of recap real quick. When we did this, we put in the 2, and that gave us 12, 17. So we had 17 for division A, and then we substituted in 0.5. So half of 6%, add that to 5, and we got 8%, and that was the return we got for division B. So we had over here 17 and 8. And then we said, okay, the firm as a whole, 1.1. So that gave us times 6 is 6.6. The 5 is 11.6. That was the return for the firm, 11.6. Then I gave ROICs and all that stuff, right? Let's do one last thing with this real quick. What did I have? I had, what did we have? We had 15 and 10. Was that numbers I had?
Yes, you.
15 and 10. Okay. Let's see. Where did I get those numbers for the firm? I actually got, once I had this stuff right here, in fact, have you guys opened up the next homework? I think you have something, because you asked me about this, right? So you got to go figure this stuff out right here. So if you remember back in the Principles of Finance course, the 3333, they say the beta for a portfolio is simply the weight, the percent you have in each stock, times the beta for that stock, and then you sum it across all the different stocks. We don't have stocks, we have divisions, but each division has a beta, right? So could you say the percent of the firm that is division A times division A's beta? So you do 0.4 times 2, and then you say you've also got another division, B, it's 60% of the firm, and it's got a beta of 0.5, then you sum it. You just simply add that up, and you're going to get 1.1 right there. So the beta for the firm should be simply a weighted average of the betas for the individual divisions. What if a firm isn't multiple divisions? What if it's the same division but multiple product lines, right? Capital budgeting projects, if you will. Like it's got 5 different product lines, and each has a different beta. Could you say, okay, product A is half of the firm, B is 30%, and then so forth, and then take those product betas times the weight, the percent of the revenue you're generating for the firm, and get the overall firm's beta? Yeah, they should work out that way, right? It should. So whether it's divisions or product lines, you can simply take the weight of that division or the weight of that product line times its respective beta and sum it across all divisions or all product lines, and you get the beta, not for the portfolio, but for the firm as a whole, right? The firm's simply a portfolio, in other words. That's all it is. It's just a portfolio of different divisions or different projects, different product lines. Could we do something similar? I got the returns for each of the divisions. So what I was using here was, the beta for the firm, 1.1 times that market risk premium, 6, plus that risk-free rate, 5. But could I have done something like this weighted average, based on these two numbers here? Probably. I could have said the R for the firm should simply be the weight for each division times the return for each division, and you sum that up. So if 40% of the company is division A, and it should get a return of 17%, and the other 60% of the firm is division B, 10%, you're going to earn Is that right? 6. That's 12.8, isn't it?
Why did you do 10 with the 17?
Thank you. I was looking, where's my mistake? I'm glad somebody's awake this morning. 8. Thank you, Travis. Just saved my bacon right there. So let's see. That's 6.8. That's 4.8. That's 11.6. It had to be that same number. I had an error somewhere, and I said, like, where is this error? I pulled a number I shouldn't have had up there, right? So the required return, the return that we need to earn at a minimum for the firm, is a weighted average of the required returns for each of the divisions, right? Could we have done the same thing for ROIC? Yeah, I don't see why not. We could say the ROIC for the firm as a whole, if 40% of the firm is Division A and it's expected to earn 15%, and 60% is B and it's expected to earn 10, then that is 12%, which is a number I didn't give you guys Tuesday. But the firm as a whole needs to earn 11.6%, and they are earning more than that, just barely. But the picture is a bit mixed when we look inside the firm. While the low risk division B is earning more than it needs given its risk, that manager is doing good. Even though they're earning less return than Division A, they're taking a lot less risk to get there. Division A is earning higher return, but you should earn even higher return because it's a riskier, right? So they're not performing up to expectations in this firm. What should they have done? At least 17% over here, right? To have decent job performance for the manager of that division. Okay, so that kind of completes everything. In the homework, I give you guys General Electric, if you open that up. General Electric is a conglomerate. They've got different divisions. Each division has a level of risk because they are in a different line of business. So that means you could compute cost of capital for each division individually, that divisional cost of capital, and the overall firm should be a composite of that, depending on what percent of the firm is of each division, right? So that's the overall math for that. Yeah.
This might be a weird thought, but say each division has its own group of products that they focus on. Would you find the weight of each of those products?
Could you build up that beta for that division by looking at the risk of each product line?
Yes.
Absolutely.
And then do the same thing with the divisions?
Mhm.
Okay.
Back before the edition we're in now, I used to use the 11th edition. Even the 14th is several old in this book. But they carved out a chapter they called corporate valuation. It's a corporate valuation model we've already gotten past now. And value-based management, EVA, all that kind of stuff, and the value drivers we're talking about, like operating profitability, the WACC, all those things, right? And there's that. There is a real-life consulting company based out of the UK, but they work globally. They're called McKinsey & Company. And they're not the only ones doing this, but they were one of the early pioneers of doing this value-based management. Consulting companies are kind of like mercenaries. They will come in and do anything in the world they can to make money, right? So if they think they can make a profit for themselves doing something, they're going to explore it and try to do it. They'll get the personnel, they'll do it. So one thing, and the more complex a topic, the more likely they might be in demand because the firm may not be able to unravel it, but maybe the consulting company can. So you have this big conglomerate with multiple divisions, multiple product lines in each division. How do you go and say, like, how much do we compensate the manager of Division A? Do we give them a bonus because they had the higher return? What about Division B? McKinsey comes in and says, no, your compensation scheme is messed up. You shouldn't base it on this right here, even though A did better. They didn't do as well as they should have, right? So they come in and they look at the risk of each division. And what are you doing? They look at the risk of each product line. How much are you earning? What should you have earned? Given that, they kind of break it down very granular as they go down through these levels. And they can tell management, like, here's where you have issues, here's where you're doing okay, here's how we analyze this, so you can go back and kind of make sense of it yourself and keep doing this analysis going forward. You can do it for yourself. It allows the company then to go and say, if we're not doing well here, we could break it down by product line. Maybe it's one of the product lines in Division A that's causing all the problems. Then maybe we can go inside that product line and see what's going on that's messing things up, right? We might be able to drill down enough to actually pinpoint the exact problem in the company or problems and then rectify it. So we're not guessing, right? That's the main thing. So we're not guessing. So exactly, you can drill this down very, very fine to specific product lines and so forth, and try to say, this product line, what return should you have earned? What return did we earn on it? Right? So like the EVA concepts, all that can apply to the firm, divisions, product lines, managers, what they have control over. We can do it like that. That's what makes it a little bit nicer than the stock price. The stock price reflects the overall firm, right? Which is all this stuff together is composite. So if I look at the stock price, it's going up. It's not going to tell me, yeah, but Division A was kind of sucking, right? It's going to say it was going up, but just in general, the firm did better than it did worse. If we can do this other stuff, we can tear the firm apart with these numbers. We can start making some good statements about what's going on inside the firm. So that's probably more answer than you wanted, but that's kind of the long of it. Is there are companies that actually do this for a living? It's part of their business, and they make a fair amount of money. They can go to companies that have money to spend to see how they can do better or do less worse, but they just don't have the expertise, the knowledge, even though it may be simple. And others that are fairly complex companies like General Electric that need the help because, well, heck, they're a big conglomerate. How do we go and tear ourselves apart and look at what's going on financially? And that's how they could do this. Okay? All right, let's look at a new topic. So today, we are in, let me bring the syllabus up real quick. So I get the chapter number for you guys. We're in the first of the capital budgeting chapters. We've got 3 consecutive ones now. All right, so we are on all right, so we're done with cost of capital. We are on chapter 12, capital budgeting decision criteria. Today, Tuesday, next Thursday, we have the cash flow and risk part of it, and then this thing called real options, right? So 12, 13, and 14. Let's see, what are the decision criteria? So you guys have had capital budgeting in the 3333 finance course. That's where you look at a project and you decide whether or not you should make the investment, right? So you compute the cash flows, and then with the cash flows in hand, you compute things like net present value. Remember that? Your present value, your future cash flows, netting out the initial cost, net present value, so benefits net of cost. What was the rule for that? You guys remember? When would you take a project if you were using NPV as your concept or your rule? Anybody remember that thing? Let's see. We'll see what it is. Okay. But you remember this, right? You remember hearing it. What was another that you had back when you did capital budgeting? What was another decision rule to evaluate a project? Yes, the IRR. And there's some others. Those are the 2 biggies that you're almost certainly going to have had back in the principles course. We'll go back over those and refresh our memory. We need to refresh our memory on those two rules. So we'll go back over those. You may have had another called the payback period, right? So those are probably the three that you've had. You may have had some others. The principal's book has a few others. Sometimes they get looked at, sometimes they don't. They're a bit more involved. I don't think they have a place in that course, but they have a place in here. So we've got a bunch of these decision rules. The decision criteria is simply, once you have the cash flows in hand, you want to evaluate them to render and accept the project or reject the project decision. That's what we're trying to do. Do we go ahead with the project, or do we say, no, let's look elsewhere, right? Here are the criteria that we're going to be looking at. So some of those that are familiar: NPV, net present value, IRR, internal rate of return. Down a few rows, payback period, we're going to look at that. Those are some of the first ones we'll get out of the way today because we've had them before, so it should be just refreshing our memory. But then we're going to have some specialized rules. And by specialized, what that means is we only really want to use them in certain situations. So when we look at the modified internal rate of return, the MIRR, we don't want to just know how to use it. We want to know how to do that. We also want to know when should you use that rule, right? It's more complex, it's more involved than IRR. So I don't want to do it if it adds more work but doesn't gain me any benefit. I want to know when that I need to use that rule, right? So when do I use modified IRR? How do I compute profitability index, PI, and when do I use it? Specialized rule. How do I compute equivalent annual annuity or replacement chain NPV, and why do I do it, right? When are they to be used? So you've got a couple of tasks in front of you in this chapter. One is very mathematical, just how do you compute the measure, and what kind of accept or reject decision do you get out of it, right? That's the first thing. That's pretty straightforward. And then for a lot of these rules, when do you use the rule, right? In what situational, right? What situation is this rule to be used? And why do we use it as opposed to these other rules, right? What makes it the better rule? Okay, let's see. Here's some cash flows, just a quick sample problem that we'll use to work through a lot of this stuff. We'll do a bunch of textbook problems as well, okay? So we're going to be doing a lot of problems in here, learn by practice. So this one's simple. 3 years. Let's say these are in millions, okay? So this thing cost $100 million today. We get $25 million next year, 75 year 2, 25 million in year 3, and the cost of capital is 10%. I'm going to skip a slide. We'll come back to it in a bit. So here's the cash flows again. Here's what NPV is. So all NPV is it says, I've got all these cash flows on my timeline. So what was it? Minus 100 today. 25 in year 1, 75 in year 2, and then 25 again in year 3. So I simply want to take the present value of each of these things. And all I'm doing is this. I think we put this form up here again before we did the corporate valuation model. We said that for each year, you find the present value of that year's cash flows by taking the cash flow that occurs in year T, and you divide it by 1 plus, in this case, your WACC, raised to the T power. You do that for each of those years' cash flows, okay? So if I do this here, I'll get 0, oh, excuse me, not 0, minus 100, right? And my interest rate's 10%, so discounted at 10% for a period. That's the initial cost, excuse me, for 0 periods, right? So 1.1 to the 0 is 1. So the first cash flow's present value is minus 100. And then year 1, I get 25, discounted at 10% for a year. That's going to be 22.7 million. And then 75 over 1.1 to the second power That's gonna give me 62. So that's the present, this is the present value of each of these three future cash flows, right? What they're worth today. I can't add these numbers, they're at different points in time. They have different time value. But I can add the present values today. So present value each thing, add the sum of all the PVs. Then lastly, I've got year 3, 25. I discount that at 10% for 3 years. And so that one's going to be a present value of 18.8. If I add all that stuff up, let's do it like this. 100 there, that's the cost, right? Let's add up the 3 other PVs, the 22.7, the 62, and the 18.8, 103.5. So in today's dollars, this thing cost me 100 million. I receive benefits in present value terms of 103.5 million. So the net is $3.5 million, net present value, okay? Can you always work any capital budgeting project just like that to get NPV? Absolutely. Which means you don't really need a specialized calculator to do that, right? You know how the calculators they give you guys in an accounting course, right? You could work this out with one of those rinky-dink things and be done with it. Just takes a little bit longer, but you could work it out with that. I don't want to take that long, so I want a shortcut. Oh, by the way, does that look like a good or bad project? What do you guys think? How come?
Because it takes into consideration time value of money, so it's saying even with those future cash flows, you're netting or profiting 3.5 million.
In today's dollars, it gains us more benefit than its cost. So it has a positive net present value. The benefits outweigh the cost. So the rule here is going to be, we accept it if NPV is positive. What if they had been a $200 million project? The present value of the future cash flows is 103.5, but you have to pay $200 million to get that benefit? Doesn't sound worthwhile, right? So if this had been a negative NPV, you'd have rejected it. You're not, it is not really apparent with this rule. We'll see it later. But if NPV had been 0, it's also an acceptable project. For most people, it's just not, it's like, how come you're not making any money? You actually are. We'll see what kind of return you're earning on a project with a 0 NPV. You're actually earning a positive return. We'll see that in a bit, okay, with a different rule. We'll see that. In fact, let me do it like this. Except positive or even 0, right? Either of those is acceptable.
Ignoring opportunity cost is, even if that was like, well, if it's 0, never mind. Yeah.
You answer your question?
Yeah.
But that's part of the reason, right? That's what it's going to get to. That's why 0 still works for us because of opportunity cost. We're already accounting for that. Okay, so this is technically what we just did. So that's what I put on the board. Here's that math again. Here, a little bit more precision here, but 3.49, $3.5 million positive. We accept the project, right? Let's go ahead and I've got a slide that summarizes this stuff. We'll go back to it in a bit once we've done a few more rules, okay? Let's look at our next rule. So, in fact, no, let's do this real quick. Let's go. What would happen to that NPV right here? This 3.5 million. So we used 10%, right? So I had NPV 3.5 million, and we had a discount rate of 10%. What do you think would have happened? We can compute it, we will in just a second. If I used a higher discount rates have been going up for firms with interest rates been going through this economy. with higher inflation. And so with a higher discount rate, what would that do to the value of projects? Yeah, when you use a higher discount rate, it makes present values lower. It doesn't change your cost right here, because that's today's dollars already, but it will reduce these. It's gonna make this a lower number, right? Let's go find out how much lower it's going to be. So here's the quick way. You guys all have your financial calculator. Here's where you need the CF button for cash flow, right? So we've used this before, I think, with the corporate valuation model. I can't remember if we did or not. Maybe did we? I don't remember. Well, we'll certainly use it now, okay? So first thing is I hit cash flow button. You see I've got stuff in there. So what I'm gonna do now is hit second, and then down here at the bottom, CE, so clear. All right, if I instead of hitting that, just hit the clear, it's gonna get me out of the cash flow register. It's gonna bring me back to the original screen and clear whatever's on that. So hit cash flow, hit second, clear my work. It's gonna clear whatever is stored in there. Okay, I wanna put my cash flows in. Cash flow at time 0. So that's gonna be 100 negative. So hit the plus minus key to make it a negative, and then hit enter. If you don't hit enter, it's not gonna store it, okay? I'm gonna hit the down arrow, and now it's saying cash flow in year 1. That's 25. I'm gonna enter that, so I store it. And then I'm gonna scroll down, and you're gonna expect to see cash flow year 2, so CO2, right? But you're gonna see F01, and it's got 1 by it. And the most part, we can ignore that, but it's a frequency indicator. How many consecutive periods do you get that same cash flow? Like, what if we got 25 million for 15 years? Do you want to enter 25 15 times? So you say 25 is your cash flow. Next key, how frequent? 15. Boom, done. Right? So it saves you some time if you have a long series of the same cash flows year after year. Right? And you say, well, we had 25 twice, not consecutive. Right? Not consecutive. They were split up by that 75. So leave that alone. It's going to default to 1, so you can almost all the time in here you can skip right past it and leave it as it is. There's the second year, 75. Enter that to store it. Scroll down. How many times consecutive? 1. So we can scroll down. 25 for the final and third year. We're done with that. My cash flows are in. I want the NPV. So I click on that button, and it's asking for my discount rate. That's the cost of capital. We use 10%. And I hit the down arrow, and it wants me to compute NPV. So up here in the top, it's got CPT. I wish I could make this larger for you guys. This is as big as it lets me expand this thing out. We'll compute it, 3.494, 3.5 million. So there's my answer. That saves me a lot of time, right? If you had a question like this in an exam, this is one of these things that, you know, as quick as you get the cash flows in, dumping your interest rate, you're done with the problem, right? So it's pretty quick. What happens if this discount rate gets raised to 15%? You guys are saying a lower NPV, right? Let's get a number. Let's go back. It's the same cash flow, so I don't have to change those. Instead, I'm going to increase my discount rate to 15. I'm going to store it by hitting enter. Scroll down. Let's compute NPV again. And I get a negative this time. Let's go back. So when I had 10, I computed, we got a positive, so it's a positive NPV. But now, when I made it 15% and it computed, I got a negative. It's not only is it lower, it's no longer a good project, right? So we got a minus $5.1 million. That would have been an acceptable project there. But the same project is no longer any good at this higher discount rate. It's not, you could say it's not earning a high enough rate of return, is what it's really telling us. So one feature about the NPV rule is you get this relationship that as your discount rate, your cost of capital goes up, your NPVs tend to go down, which should make common sense. If it costs you more to finance a project, then the same cash flows will be worth less today, right? Or there's less benefit for you after you pay the bank, right? So that's kind of a way of conceptually thinking about it. You gotta pay the bank more interest, there's less left over for you, it's not as good of a project, even though the cash flows are exactly the same as they had been. Last year, or a year and a half ago, when inflation was rising, two of you can't answer this because we've answered in another class. When inflation was rising, interest rates were going up. What do you think was happening to the cost of capital for firms? Conceptually, all rates look like this. They have a risk-free component plus some risk premium. When we talk about stocks or companies, the risk premium is that market risk premium that we talk about, right? Or the equity risk premium. And the risk-free rate has a real rate. This is economic growth. So you look, is GDP rising or falling? Real GDP after you take out inflation. But then there's also an inflation component. So if inflation is rising, then rates should rise. Like what rates? The cost of debt? Yeah, very definitely cost of debt. What about the cost of equity? Yeah, equity risk premium, market risk premium. It doesn't matter. All risk-free rate, when that goes higher because of higher inflation, all rates tend to rise with it. So if you had a year and a half ago rates starting to rise because of inflation, what was happening to firms? Their future investment prospects were being diminished because of higher rates. So projects that had looked good suddenly either look bad or they still look good but just not as good as they had, a lower NPV. What's been happening since summer of last year? Inflation's come down, right? So presumably rates have dropped a bit from last year for firms. If that's the case, lower inflation, lower risk-free rates, then that would suggest lower cost of capital since a year ago. Now projects are looking a bit better than they had, right? Things are looking a bit more rosy than they had before. So a little bit of a side note here. That's not quite what the chapter is getting into, but what happens in the economy affects the discount rate. And as the discount rate is affected, as it moves up or down, that's going to change the value of our projects. It's going to move opposite, right? Just like a seesaw. So higher discount rates, lower project values, and vice versa. If I did a whole bunch of these like in a spreadsheet for this thing, we might get something that looks like this. Put NPV on the vertical axis, and I'll put my discount rate on the horizontal axis. And at 0, there's positive NPVs and negative NPVs. At 10%, I had a positive NPV. At 15, I had a negative down here. So it looks like this thing is doing something like, it looks like if I graphed it, I'd probably get a line that looks like that, right? So here is, 10%, 3.5. At least that's the point over here. 15%, here's my minus 5.1. All right, we can keep filling in the blanks and getting more and more points on that line with more discount rates, just a bit more work, but you see the basic idea. I've got a very interesting point in that graph though. Do you see what it is? The 0, right here. A low enough rate, this has positive NPVs, not a positive NPV, positive NPVs, all up in here, right? It's positive. If rates get high enough, we did 15, it's negative. It looks like I probably could have had it high, but not as high as 15, it still would not have been a good project. Negative NPVs, accept region, reject region. But I also said it's still acceptable when the NPV is 0, right here. So I want to know that point right there. I want to know what is the discount rate that gave me a 0 net present value, okay? So what am I doing here? Well, let's go back to this thing real quick. When I set this up, I had my cash flow today, let's just say CF0, and then I had my cash flow in, let's do it like this. So this is what it looked like doing NPV. What if I did the following? What if I said, let's see, that's just gonna be 100 regardless. I wanna go and find an interest rate that instead of 10%, I plug this new interest rate in, and I make this guy here equal to 0, right? 0 NPV. I want to know what rate would have me exactly where this NPV line crosses this horizontal axis, a 0 NPV. So I'm ultimately trying to solve this. Now, this is going to be a problem that rinky-dink accounting calculator can't help us out with. I don't have any accounting majors in here, do I? Thank goodness. I get in trouble, probably get in trouble for this anyway. So you see what's happening now. Instead of all this stuff over here, and I take some time to work it out, I'll do it really quick with that calculator and get my number, you know, my 3.5 million. Now I'm asking a different question. I'm saying, I'm looking for a rate that gives me a 0 net present value. What is that rate? Right, where I plug it in all of the present value equations. Now that if I did this, how could I do it? I've already got 2 points, 10 and 15%. I know it's somewhere in the middle of that. Is it like dead in the middle? I don't know, but I could try 12.5%. Like what if I did 12.5%? Come back up here, 12.5, let's enter that. Let's compute. Minus 9.96. It's still about a million negative. It's still over here. So I know that's getting closer to a 0 NPV, but it's still not there yet. Could I keep doing trial and error and finally get the right number? I can, but that's messy, right? So is there a better way? Absolutely. We can solve the IRR, the internal rate of return. And if I do that, 11.946, let's write that number down. IRR is 11.946%. I'm going to take that number. Let's go back to the NPV real quick. NPV, let's put in that discount rate, 11.946. Enter it. 0 NPV. You see what's special about the IRR? That is that rate that gave us a 0 net present value. That's on that borderline between being acceptable, positive NPV, and rejected, negative NPV. Put differently, IRR is the cost of capital that makes the NPV formula give you a value of 0, right? That's all it is. You know, if you were in Judici's course, he's got the love of math, he'd say IRR is the discount rate that makes NPV equal to 0. And he'd tell you, always tell that to somebody else, right? Gives you a 0 NPV. But you get out of here, you graduate, you got your job, and you tell your boss, you know, they ask you for a good definition for IRR, and you say, oh, it's the discount rate that gives you a 0 net present value, and they tell you, okay, that sounds good. Pack up your desk, here's your last 2 weeks of severance pay. Right? So they want a more layperson definition of what the IRR actually is. Okay? So what actually is it? It is the expected return on a project. So it's the expected return. So for this project, we had two important numbers when we look at IRR. So for IRR, you've got an IRR of 11.94%. That's the return we think we're gonna earn on this project, almost 12%. How much does this project cost us? Well, it cost $100 million, but what about in percent terms? What does it cost us? What kind of return do we need to earn at a bare minimum to make it a worthwhile project?
11.9.
Hmm? 10%. Your cost of capital is the weighted average of what the providers of your financial capital require as a minimum. Be happy to get more. They want this as a minimum. If you think you're going to earn that expected return, you need to earn at least that required return. That tells us our rule right there. IRR tells us the project's good when the IRR is above the cost of capital. You expect to earn a return more than what investors require. That's what we're doing, okay? So here, this is going to be greater than the WACC. Expect to earn 12, we need to earn at least 10. That sounds good. If it were less than the WACC, then we would have rejected the project. So what if our WACC had been 15% right here? We can see when we did NPV, it was negative. Does IRR give us the same decision? It should, or it's not a very good rule, right? And sure enough, we need to earn at least 15%. Cost of debt's gone up, required return for shareholders has gone up, they now want collectively 15%. We only think we're gonna earn 12% on this project, 11.94. It no longer sounds very good, right? It's not enough to compensate our investors with their minimum required return, the WACC. So we scrub the project, now we get rid of it. Now, what if investors didn't require 10%, they didn't require 11 or 15, what if they required 11.94%? Is that a good project now?
May not be ideal, but you can still do it.
How come? It's not as good as 11.94 versus 10, but yes, we should still accept it.
You're still delivering on what they're requiring for return.
So this gets what Travis said about opportunity cost. A lot of people think if the IRR and the WACC equal each other, expected return equals the cost of generating that return, then you are earning no money, no profit. That's not true, because one of the components of your WACC is what? The return that shareholders require. Remember that? That's part of your WACC. It's the minimum return they require. So you are earning a minimum return for shareholders, right? You're earning what they need to be earning to compensate for the risk involved. In other words, you're covering their opportunity cost. Right? So because of that, we can also say that if the IRR is not just greater than, but equal to the WACC, we accept it. I made this graph a little bit messy here. It's kind of works like this. With NPV, if NPV is positive, then the IRR is greater than the WACC. NPV is negative, it's less than the WACC. And if NPV is 0, the IRR and the WACC are equal to each other. It's going to work out like that. Again, doesn't mean you're not earning any profit here. It means that you're earning just enough profit to compensate shareholders the amount they require at a minimum. What are you doing over here, though? You're earning more than they need, right? You're earning excess returns. So we could say, put in brackets here, excess returns. And believe it or not, you've had this concept before, though you probably don't realize it. You're earning positive excess returns here. Whenever your NPV is positive, you're earning more than your WACC. That is, your IRR is above your WACC. You're earning excess returns. Over here, your excess returns are negative, right? And then here, your excess returns are 0. You guys have had this concept of an excess return. You've known it as EVA, right? You know it as EVA, where if the ROIC is greater than the WACC at the firm level or the division or the project level, if that part right there is positive, you're gonna have a positive NPV. If it's negative, you're gonna have a negative NPV. What did we say? We wanna see, we'd like to have positive EVA, right? Because that's when our stock prices should rise in our firm to reflect it. What does that mean here in capital budgeting? It means that firms that have projects whose IRR is above their cost of capital, or conversely, positive NPV, we should see their stock prices rise, reflecting the value of those projects, reflecting the excess returns. They're earning more than investors require to be compensated for the risk involved. What if you had a company that's making investments, but they're really awful, and the NPVs are negative, the IRRs are below the cost of capital? Then their excess return is negative, meaning what's gonna happen to their stock? It's gonna fall, right? Negative EVAs, their stock should fall. That makes sense, right? They're making really bad investments. Their stock probably should fall. They're losing value. They're destroying value by doing that, right? Do companies knowingly make bad investments? You'd hope not, but we look at projects from, forecasting, like we haven't invested yet, but should we invest? Do you think projects always work out the way that companies hope they would? No. Once the company decides, yes, let's invest in this project, could things change and that project that is now accepted go bad? Yeah, maybe interest rates skyrocketed because of inflation. And when rates were low, it was a great project, so we pulled the trigger and we did the project, but now that we're in it, rates have skyrocketed, it's no longer a good project, and there's just nothing in the world we can do about it. It does happen, right? It does happen to companies. So, in which case, they've lost value, and they're going to see their stock prices decline, right? On projects that did look good, but now that they've taken them because of things outside their control, they're no longer good. Do companies sometimes take projects knowingly that are bad? I used to have a chapter in here called corporate governance. I've taken it out just because of time constraints, but it would get at, sometimes managers have different motivations than the investors who they're supposed to be taking care of. And if I have what motivation may I have? I may be compensated more money if I have a larger firm to run. And so by simply investing in really big projects, I have a larger firm. Those projects may be really awful and lose value, but they're bigger, they'll make the firm bigger, I may get higher compensation. Do we see some of that? We actually do see some of that in the marketplace. You could call it perverse incentives. If CEOs are compensated based on company size, then they may have an incentive structure to invest in the big projects regardless of whether they add value or destroy value. And that can happen.
What's the likelihood of a firm hitting 0 on NPV or matching?
Coincidence, just dumb luck in practice. But, as rates get higher, we're gonna either move there, or as they get lower, we're gonna move there, right?
So if NPV is 0, wouldn't a company be more hesitant to do so in case that there is that risk?
Okay. Yeah, so two things there. So in theory, okay, keep this in mind, in theory, textbook approach. When do we accept projects by NPV? When it's positive or 0. By IRR, when it's above or equal to the cost of capital. In practice, would we find a great, by the way, what do you think would happen to stock prices in a firm? What would excess returns be if you accepted projects whose NPV was 0? What would the excess returns be? 0, right? What would happen to stock prices if we accepted projects like that? They wouldn't change, right? So you see something important here? If you want to make your firm go up in value, you invest in projects that have excess returns. Their NPV is positive, they earn more than their cost of capital. You should avoid projects that are exactly the opposite. Negative NPVs, returns IRRs below their cost of capital. If you invested in those right at the margin, right, or right at the that kind of inflection point where NPV 0, IRR equals the cost of capital, it shouldn't do it. The company will get bigger because you've got more investments, but it should not do a thing for your stock price. It should stay where it was, okay? So this gets me to my answer to the question here. Should a company in practice take on an investment that has 0 net present value, or IRR equals the cost of capital? Depends on your perspective. If I get bigger, maybe in getting bigger, I'm taking over more market share. And eventually, maybe higher market share gives me some market dominance that I can exploit. So it doesn't do it for me yet, but maybe if I move in that direction, I might get something out of it later on. If I'm considering things like that, like competitive analysis, maybe so, right? If I think, I'm a gas station in a world full of millions and millions of gas stations, highly competitive. I can add on, 1,000 gas stations. I'm probably not going to have a whole lot of market power. Still a very competitive marketplace. I don't know if I want to take on a new gas station that has a 0 NPV, right? It depends on what I think is going to happen to my competitive position. If I'm very competitive now, so I'm going to get 0 NPVs. But I get bigger and I'm still very competitive, it doesn't really do me much good. It may boost my ego, but it doesn't do me much good in terms of creating value, right? On the other hand, if it gives me a more competitive position, a competitive advantage by getting bigger, because I'm dominating more of the marketplace, then, in fact, I might want to go back and redo my cash flows to reflect this change in competitive position. And if I did that, I'd probably find that I'm getting a positive NPV. So I may have gaps in my analysis of my project when I'm doing this thing. So that's kind of the long-winded answer to your question. It depends, right? It depends on some other factors that we've talked about this semester, like competitive positioning, competitive analysis. Is the market very competitive, or is it very, say, fragmented and non-competitive? Those kinds of things. Okay. NPV, basic IRR rule. There are a few other points about each we'll come back and see in a bit. But that's the main gist of them there. So, what was this point right here? I want to put a name on this thing. I don't want whack right there. What do I call that guy instead? That's my IRR. Yeah. My IRR, 11.94%. Rates higher than that, the project's no good. Rates below it, the project has a positive NPV. This, by the way, this graph right here is referred to as an NPV profile. It's simply let's just compute a bunch of NPVs for different discount rates. Let's graph it. Let's see what it looks like. And you get that thing right there. And there's exactly that graph, right? There's that guy right there. I've got, it looks like 12%, 11.94. Here's the negative, right? We were at 15%, we had minus 5.1 million. We had 10%, about 3.5 million. Could have gotten a lot better. If we could have gotten money for free, 0%, it would have been 25 right here, right? By the way, the one time you can ever add these cash flows up, like minus 100, 25, 75, and 25, just add them all up. If your discount rate is 0, you're dividing by 1. So that's the one time in time value of money that you can add everything up across the timeline, is when your discount rate is 0. Will you have 0 discount rate? No, but it lets you complete the graph, because if I get that number, 25, and I skip my NPV, but I compute my IRR here, then I just draw a line from there to there and just keep drawing it down. I've got my profile. I don't need Excel to do it. Just 2 points, right? And you can draw the line. That's the one you got to compute, though, and that one you can get real easy just adding those numbers up. All right, so 25, 75, 125 future cash flows. Cost 100 for 25 ahead for a discount rate 0. That's the vertical axis right there. Okay, let's see here. Let's do this. Let's, there we go. Okay, let's look at this project here. Oh, but let me do one more thing. Let's get this out of the way real quick. Let me put the project cash flows back up here. Let's do payback period, okay? This is an easy one. Let's get it out of the way real quick. And then we'll try to get this problem done as a final thing for today. So, payback. So what's the rule on this thing? Well, how to compute it first. It's a nice rule. I don't have to do any discounting. I completely ignore time value of money. I'm not going to add this stuff up. I'm going to do a little bit different. So let's do it like this. In year 0, I have, let's call it a balance. If I buy the project, I owe $100 million, right? That let's just leave the negatives out. $100 million is how much it cost me, right? Times 0. And in year 1, I get 25. So 100 minus 25, my balance is 75. That's how much it cost me that I haven't paid off yet, okay? And year 2, 75, we get 75, my balance is 0. Now, obviously, I'm not adjusting for opportunity cost of these funds because I'm using a discount rate. You can see there's a problem here. So I'm just using the cash flows as they occur and saying, like, when do I pay this? It's a bank loan. When do I pay the bank loan off, right? In year 2. So the payback is, because that's now 0 in year 2, it is 2 years. All right? What if the cash flow had been like this? What if instead of 75, it had been 60 in that year? So 75, we get 60. We have a balance of 15 left to recover, left to pay off. In year 3, we've got 15 to pay off, right? It's just that number there. But we get 25. We've got more than we need. So we don't need an entire year of cash flow in year 3. We actually need about 60% of that final year's cash flow. So in this case, changing that from 75 to 60, my payback is 2 complete years and 60% of year 3. So my payback is 2.6 years. That's how you get the payback period. Super simple. Is there a clear-cut rule? Not really. But you could say shorter paybacks are preferred over longer paybacks. But that can get you into trouble, right? To show you how much it could get you into trouble, let me show you a slide on this rule real quick. Look at project. Where's my shortest? I got 6 projects. I want to pick the best one, right? I want the single best project. If I use the payback rule, and there are plenty of firms that do, which one do you think I would have used or picked? Which project?
A.
A. But you see the problem with it? I'm going to destroy value, right? It gets me back exactly my initial cost. By the end of year 1, my payback is 1 year. But if I had used any discount rate whatsoever, any discount rate above 0, I'd have gotten a negative NPV on that project. It would not have been good. It's going to destroy value. The higher the discount rate, the more negative this thing's going to be. So if I used the payback period rule, I probably would have selected A, but it's not a good project. It's going to cost me value here. The payback period rule doesn't tell me anything about this. It simply says, how quickly do you get your money back? How liquid is the project, right? It looks at liquidity risk. Turning the project cash flows back into cash, right? Getting that thing paid off is all it's asking. Let's look at a couple of these others over here. What if I was choosing between D and E up here, these two projects? Clearly, it looks like at 10%, it looks like E's the better project, right? Higher NPV. I probably would have taken E. But if I used the payback rule, I get my money back sooner with D. So I probably would have picked D, but I would have gained a lot more in firm value if I had picked E. Let's look at D and F over here. They both have the same payback. So from the payback period rule perspective, they look, I'm indifferent. One's no better than the other. See this big fat check right here? You see what it does to NPV here? I should take project F. It is by far the better of the two projects, but payback doesn't care, because once you've gotten your money recovered, it doesn't say anything about what's left, right? It says nothing about cash flows after the payback period has been completed. It could be a lot, or it could be very little, and it doesn't really care about that. So there's some definite problems with the payback period rule. You can kind of see them, what the issues are. I've got a slide before it that goes through the issues, but you can see them on this slide right here. Do firms use it? Not as much as it used to be. You know, we now have these things, we've got Excel, all this stuff so readily available. It's hard to have a justification for using it. It still gets used. It gets used more by smaller firms than large firms. It gets used in large firms sometimes just as a quick little check, like a back of the envelope calculation, but it can lead you astray, obviously. You can think, oh, I bet you it might be more the unsophisticated small firms that are using this rule, and that tends to be the case. But like I said, even large ones tend to use it still. And it's not because they're dumb. It turns out people who've looked at the use of payback rule have found some interesting things. There are times it's used in a very legitimate way, even though it's not the optimal rule to use. For example, what if I'm a firm and I've got a really large amount of debt that I owe? I've got to pay my creditors back fast, right? So would I pick, let's see, what's a good example here? Let's go back to D and E real quick. You know, those are my two choices. I get my money back, I pay off the project cost sooner with D than I do with E, a shorter payback. D is more liquid between these two. You may say, but you should take E, has a higher NPV, it'll bump up the firm value by a lot more than D does. But why might I have a rational reason for taking D? I owe a ton of money to my creditors. They're calling me up every day saying, if you don't pay us back soon, we're gonna call your loan and, you know, we may put you into bankruptcy, right? I have got no choice. I can't wait for my cash flows to come in on the better project. I need to get something coming in that pays these loans off. I may be cash flow constrained, right? Or I can't take the optimum investment because of other constraints that are imposed on me with the way I finance my firm. And so we find a lot of that. There are a lot of companies, when times go bad in the economy, companies that have, say, a high debt burden tend to have liquidity constraints in placed on them. And because of those constraints, we find that they end up taking more suboptimal projects, but they do it for a rational reason because they pay off sooner. They get the cash flows in sooner so they can pay off what they owe to creditors. Their firm value is not going to go up as high as it would have if they'd taken the better projects, but that's the cost they pay, right? That's the price they pay for that. Okay. Let's look at one last thing. We've got a few minutes. I don't know if we'll get through it or not. Let's look at this problem right here. Normally I'd have you guys work through it with me, but I'm going to go ahead and put the numbers up here, and we're going to simply sit back, and instead of working through it, we're going to interpret what we can do with this. So you can see the cash flows, years 1, 2, 3, and 4, and up in the narrative they say at time 0, year 0, the initial cost is an outflow of $25 million. So there is the initial expenditure, $25 million, okay? So let's put the two projects side by side. Here's A, here's B. If you kind of look down through the different questions, they say, calculate the NPV if the cost of capital is 10%. And then they say, I go down a bit further, they say, calculate the NPV if the cost of capital is 5%. And then do it again if the cost of capital is 15%. So like we saw before, we're gonna get 3 different NPVs. They'll probably get progressively lower as the cost of capital goes up. So let's compute them anyway, right? So I'm gonna do the NPV at a 5% discount rate or cost of capital. And I'm gonna get 16.1 million here and 18.3 here. B looks better, okay? Or let me back up real quick. If these 2 projects were independent, that means that I look at project A and make a decision. Project A looks good. I look at project B and make a decision, ignoring project A. B looks good. I do A and B. If they're mutually exclusive, it means I have to look at the set of projects and take the best project that is acceptable. And the best one looks to be project B, right? Higher net present value. My firm value should go up by more with project B than it does with A, reflecting that NPV. By the way, real quick, firm values go up when NPVs are positive. By how much? If we take on project B, firm value should go up by $18.3 million. If I take on A, it should go up by 16.1. I like that better than that. The NPV is how much we should expect firm value to increase by if we accept a project. Okay, let's see. NPV at 10%, could be a bit lower for each of these. It's going to be 12.7 million and 11.6. If they're independent, they're both positive, so I'm still going to accept them both. If they're mutually exclusive, A's now better. A's the better project, higher NPV. If I do 15%, I'm going to have 2 lower numbers again. And if I can check that, that may be wrong. I don't think I believe that number. Let's put that back up here. In fact, I know that's not correct. You guys might want to put like a question mark there. I think I made a mistake of doing it really fast, but we'll check it, okay? In fact, that's eating out. Let me do it real quick. Maybe got something wrong in there. I'm gonna make life simple. Let's just get rid of that one right there. I don't like that it's up there, so I'm gonna change the problem a little bit. Let's just get rid of that, okay? So clearly, which one's the better project depends if they're mutually exclusive, right? Over here. If they're mutually exclusive, if they're independent, it doesn't matter. I'm gonna do the both of them because they're both positive. But if they're mutually exclusive, I take the single best project. My decision depends on my discount rate, right? It clearly depends on it. Let's look at the IRR real quick. Here's the IRRs. It's 27.3% and 36.2%. Remember, it doesn't say anything about, the only thing here is, are they above the WACC? Well, it doesn't matter if it's 5 or 10%, they're both above the WACC, right? They both are. So they're both gonna have a positive NPV, and we see it here. Which one, so they both meet our rule, right? We take them both if they're independent. No problems here at all if they're independent, but mutual exclusive, which project would have been better? B, right? Higher IRR, so it would have been B. In fact, let's use this guy here. Let's use this one. Let's look at this. Let's say that our cost of capital is 10%. Okay, forget the 15 or the 15 and the 5. Let's say it's 10%. So you've got these NPVs here, and we got this set of decisions here. And then alternatively, the IRR, we've got these rates here, and for mutual exclusive, we got project B. This is why I picked this problem. Which project should we pick? You've run the numbers. Your boss is sitting there staring you in the face because you're doing the presentation to the rest of the board and the senior executives, and they're tapping their fingers now. Okay, so you're telling me they're both good? Yes, sir. Which project do we take? Do we take A? Yes, sir. Do we take B? Yes, sir. We can't do both. Which one do we take? Which one do we take? Is it A or B? A? How come?
The NPV is gonna be higher, so it's gonna add more value.
The firm value will increase by the amount of the NPV, and that is higher here than it is here. So when you have mutual exclusive projects, you can have a conflict in the decision of which one looks better between the acceptable projects. And the better project is always going to be the one that increases firm value by the most, the higher NPV. So mutual exclusive, the rule of thumb should be ignore IRR. It can lead you astray to the wrong project. It's acceptable in its own, but maybe not the better of the projects, right? So here, we want project A, higher NPV. We're going to hit all the other rules, the modified IRR, the equivalent annual annuity, all that other stuff on Tuesday. And we're going to come back to this problem real quick and do one more thing with it when we get it on Tuesday, okay? We'll do something called a crossover rate on Tuesday. All right, so have a good weekend. I think that homework on cost of capital, is that Monday? It is? Okay, okay.
Last two what the crossover rate was. A little bit, yeah.
Oh, down at the bottom?
Yeah, I was looking at it.
We'll see that. We'll see that, how to compute it, how to interpret it.